What if everything you've been told about the 2008 financial crash was a lie? What if instead of saving the economy, a secret mechanism was activated to permanently transfer wealth and power to the banks? While the rest of us were fed the line, "We're all in this together," imagine this. You're struggling with debt. You see your rent spiking, prices for everything going up, and your job feels less and less secure. You're told the government is working to protect you. But what if the real rescue mission was never for you? What if your financial pain was just considered acceptable collateral damage in a game you didn't even know was being played? Where are you watching from? Drop your city or country in the comments below. Let's see how far this message is reaching. If you are tired of the official narratives and want the unfiltered truth about how money and power really work, hit that subscribe button and turn on notifications. Because today, we're pulling back the curtain on the secret that reshaped the modern world. The wait is over. Let's dive in. Our journey begins not in 2008, but way back in 1913. This was the year the Federal Reserve Act was passed, quietly and fundamentally reshaping America's financial landscape. The official story we were given was that it would bring stability and prevent financial panics. But the reality? It created the perfect centralized machinery for controlling credit, managing liquidity, and most importantly, operating in secrecy. From that moment on, the largest banks were no longer solely dependent on the deposits of their customers. They now had a direct, invisible lifeline to the newly created central bank. It was a safety net, but one woven exclusively for them. Does that setup sound familiar? It should, because it's the blueprint for everything that came later. Now, let's fast forward a few decades to the 1970s, a pivotal moment in monetary history. President Nixon takes a dramatic step. He closes the gold window. In simple terms, this severed the US dollar's last link to physical gold. The world officially entered the age of fiat currency money, backed by nothing but government decree and faith. The promise was one of freedom and flexibility. Governments would no longer be constrained by their gold reserves. They could manage their economies more effectively. But what was the result? Unlimited government debt, unlimited bank bailouts. In a global economy built not on tangible value, but entirely on confidence, and when that fails, on intervention. Does this echo the world we live in today? Absolutely. It set the stage for the grand rescue operation to come. And that brings us to 2008. The mortgage markets, bloated with toxic subprime loans, finally implode. The entire global financial system grinds to a halt as credit freezes. Panic grips Wall Street. And within days, the very institution that was created to stabilize the system, the Federal Reserve, steps in as the lender of last resort. But here's the crucial question. The lender of last resort for whom? It wasn't for the millions of homeowners facing foreclosure. It was for Wall Street. You were told it was a rescue mission to save the economy, but the hidden truth is much darker. It was a monumental transfer of risk. It's the bad bets, the toxic assets, the trillions in liabilities. They were systematically moved from the balance sheets of private banks onto the public ledger. Your ledger? It was a shadow operation, executed with breathtaking speed and silence, moving trillions of dollars without a single public vote. The Federal Reserve didn't just perform its usual tricks of cutting interest rates or buying a few government bonds. No, this was something else entirely. They created a labyrinth of new off-books liquidity pipelines that ran completely outside of public oversight or congressional approval. This wasn't just a bailout. It was the construction of a parallel financial system, hidden in plain sight. Think about that for a moment. Hey, does that sound like a rescue from Main Street? And here is the twist that connects it all to your life today. The ever-widening wealth gap, the relentless rise in the cost of living, feeling that your savings are constantly being eroded by inflation. These aren't separate, unrelated problems. They can all be traced back to the architecture of this invisible rescue system. The idea that too big to fail banks were bailed out while regular people got wiped out isn't just a talking point. It's a cold, hard, mathematical fact recorded in the Fed's own data. Between 2008 and 2009, the Fed didn't just buy up bad loans. It engineered a secret financial network, a system that economists now refer to as the shadow banking liquidity system. This was a complex web of special lending facilities, currency swaps, and hidden guarantees that quietly funneled an almost incomprehensible amount of money over $16 trillion to major domestic and foreign banks. Now let's name a few of these secret pipelines. Facilities like the Primary Dealer Credit Facility, or PDCF, and the Term Securities Lending Facility, TSLF, were created overnight. They were designed to hand out trillions of dollars in interest for overnight loans, often accepting toxic mortgage-backed securities as collateral, the very assets that nobody else would touch. The PDCF alone pumped out a staggering $8.95 trillion in short-term loans to investment banks. These were the same institutions whose reckless behavior caused the crisis in the first place. Think about the scale of that. It's more than half of the entire US GDP at the time, created and distributed in the shadows. And here's the most outrageous part. Nearly all of these transactions were never voted on by Congress, never debated in public, and were barely reported to the American people until years later, after journalists and auditors forced the data into the light.
Wow.
While Wall Street was receiving a continuous, free-flowing foredrip of credit, millions of homeowners were being foreclosed on, losing everything. The system prioritized the health of the banks over the survival of the people. It was the greatest wealth transfer in modern history, conducted under the guise of an emergency. The losses were socialized, but the subsequent profits were privatized. After being rescued, the banks went right back to paying out record bonuses, their risky behavior fully validated and insured by the public. And who was the mastermind who signed off on it all? Who was the person with the ultimate authority to approve this multi-trillion-dollar shadow operation? You won't believe the name, and understanding their role is the key to unlocking the whole story. Before we reveal that, I want you to really let this sink in. A secret system was activated, one that reshaped our economy in ways we are still feeling today. If this information is resonating with you, please share this video. The more people who understand this, the better chance we have of demanding real change. We've just pulled back the curtain on how in 2008, an invisible web of rescue lines quietly moved $16 trillion in credit through the Federal Reserve's hidden corridors. But who built this network, and how deep does the power really go? Let's dive even further. When Wall Street's skyscrapers shook in 2008, the crisis wasn't just about bad mortgages. It was about the collapse of confidence, the very oxygen of modern finance. Money market funds froze, repo lenders panicked. And deep within the Federal Reserve, a handful of officials began drawing up what insiders would later call the emergency liquidity architecture. This wasn't policy. It was improvisation on a global scale. Within days, the Fed launched facilities with cryptic names: PDCF, TSLF, AMLF. These acronyms sounded dull enough to escape headlines, but were powerful enough to reshape capitalism itself. Each program rewired a piece of the financial bloodstream. PDCF, or Primary Dealer Credit Facility, pumped nearly $9 trillion in revolving credit to Wall Street's biggest dealers. The TSLF, or Term Securities Lending Facility, allowed investment banks to swap their toxic paper for pristine U.S. Treasuries. And the AMLF, the Asset-Backed Commercial Paper Money Market Fund Liquidity Facility, unleashed $150 billion in just 10 days to stop money funds from imploding. Then there was the $85 billion lifeline for AIG to halt global contagion. The TARP program, that publicly debated $700 billion plan, was merely the visible tip of an invisible mountain. In total, more than $16 trillion in commitments, according to later independent audits. And none of these were voted on. They were authorized by a single signature. And the mastermind who approved it all? The name might surprise you. Ben Bernanke, an academic economist turned central bank chief, a man with no ballot box mandate, yet holding the power to mint or erase fortunes with a single phone call. It was Bernanke who signed off on the backdoor rescue programs, who opened swap lines to Europe, and who expanded the Fed's reach far beyond any congressional oversight. When an independent audit finally exposed the numbers in 2011, lawmakers were stunned. Foreign banks in the UK, Germany, and Switzerland had quietly tapped U.S. liquidity through the Fed's window. Bernanke called it preventing a collapse. His critics called it the birth of technocratic rule, an elected government of money. And the most chilling part? The structure he built never disappeared. It simply evolved under new names: standing repo facilities, overnight swap lines, and the endlessly elastic quantitative easing. The terminology changed. Power didn't. Imagine a secret circuit connecting every major financial hub on Earth. When stress appears, say a European bank faces a dollar shortage, the Fed quietly extends a currency swap, flooding that bank with liquidity. No vote, no headline. It's just an electronic keystroke moving billions across borders. During the 2008 crisis, these swaps peaked at $580 billion in a single week. The Bank of England, the ECB, and even the Swiss National Bank became temporary clients of the US Fed. It was global triage disguised as domestic policy. And here's the moral twist. Every dollar created to stabilize the markets diluted the purchasing power of the dollars already in your pocket. The pain was public. The rescue was private. Let's lay out the receipts. $11 trillion in household wealth vanished in the crash. $10.5 trillion in mortgage debt had fueled the bubble. $16 trillion in emergency credit saved the system. The Fed's balance sheet surged from $870 billion to over $4 trillion within months. And median U.S. wages? They barely moved 2%. The result was a recovery that looked like prosperity from 10,000 feet, but felt like stagnation on the ground. Stock indices soared. Assets inflated. Housing rebounded for investors, not for homeowners. The illusion of recovery became the narrative of hope, while inequality became the architecture of reality. The rescue mechanism became doctrine. Whenever markets stumble, central banks intervene. Greed was no longer punished. It was backstopped. Economists call this moral hazard, but it's bigger than that. It's a cultural shift, the idea that risk is optional for the elite but inevitable for everyone else. Think of it like a casino where the house always wins because the house wrote the rules, prints the chips, and loans you money to keep playing. This is the shadow empire of money, invisible, technical, but absolute. When the pandemic hit in 2020, the same system flickered back to life automatically. Within weeks, the Fed injected $9 trillion in repo support, even faster than in 2008. By 2023, global debt exceeded $300 trillion, 3 times the world's GDP. Different crisis, same script. The liquidity machine never sleeps, just changes disguises. Every inflation spike, every crypto bubble, every sudden crash traces back to this algorithmic reflex. Print, rescue, repeat. The next crisis won't need a 2008-style moment. It's already coded into the system. Markets now move at the speed of data. Algorithms trade billions in microseconds. When liquidity vanishes again, the rescue will be instant, automatic, and global. But every rescue draws from the same well, your future purchasing power. Debt is monetized. Savings are diluted. History repeats. This isn't a conspiracy theory. It's documented history, with receipts sealed in Federal Reserve spreadsheets and IMF archives. We live in an era of borrowed time, borrowed money, and borrowed trust. The same invisible hands that lifted Wall Street in 2008 are still gripping the levers of the global economy today. When the next bubble bursts, the mechanism will activate automatically, not to protect the many, but to preserve the few. So, ask yourself, are we wiser now, or are we just walking the same path in better suits? If you're still watching, you're part of the few who look beyond the headlines. Drop a comment saying a WAKE if you refuse to sleepwalk through history. Share this video so more people understand that the past isn't over. It's compounding interest. And if you want more deep cinematic dives into the hidden history of money and power, subscribe to Mysteries of Time, where we reveal the truths they'll never teach in school. Thank you for watching.